Hello investors, welcome to Business Learnings. It has been quite some time. I had been busy and was not able to make any videos for quite some time now, but this video is about IDFC First Bank. The bank recently declared its results for the fourth quarter of financial year 2020, and the results are encouraging. I have made a couple of videos on this particular bank and I have always been talking very positive about it. Am I still positive for the bank? What is going to be the target price? How the bank will perform in the next coming quarters, in the next few years? Should you invest in this bank? Should you not? We will discuss all these kinds of things in this video, so do watch the video throughout the end to get a better idea of things. Okay, so just a quick note that you should always keep in mind while you are analyzing any kind of banking stock is a few factors: net interest margin, the fraction of their loans, their loan portfolio. I mean, what percentage of loans are given in what industries or what kind of people, the provisioning, the NPA numbers, the quality of the promoter, and the current and savings accounts proportion of that bank. Let's try to analyze IDFC First Bank along these points, and we will get a better idea of if the bank is performing good enough or not. So, as you all know, IDFC First Bank is a merger of Capital First and your IDFC Bank, and the merger happened in somewhere in September-October 2018. So the first quarterly result of the bank, it was declared in December 2018, and at that point the bank had 35 of the loan portfolio. The bank had 35% retail loans and 65% corporate loans. Now, as of March 2020, 54% of retail loans and 46% of corporate loans. Their strategy, their vision has been more towards giving out more of retail loans and reducing their proportion of corporate loans. And they wanted to do it in the next 5 years, but based on the rate at which they are converting, I don't think this is going to take 5 years. It's going to get there. They are going to get there in maybe 2 years or so, 2 or 3 years at most. Why do retail loans matter? Why do corporate loans are bad? Why do retail loans are good? Retail loans are good because on retail loans, banks typically charge higher interest rates. First. Second, your risk is highly diversified. For a corporate loan, if a particular corporate entity defaults, your entire money is gone, right? Loan ticket size is in thousands of crore rupees. One default and thousands of crores of rupees is gone, right? For retail loans, even if some people default, the money that's gone out, that's written off, is not much. These are two key reasons why a retail loan is preferred over a corporate loan. Now, in these tough times, in coronavirus times, normal people like us, retail people, they are also facing a lot of pressure. They are not able to, a lot of them actually are going to default, and that's why retail as well as corporate loans are under pressure. So coronavirus is going to hit all of the banks equally hard, be it a corporate loan focused bank or be it a retail loan focused bank. So yes, that's an issue. Now let's look at the overall loan book. If you talk about a lot of different banks, you must have observed that they focus a lot on growth. This bank is focused on quality. Their entire loan book size, it's not growing very fast. It's not growing. In fact, it's had been stagnant. Their loan book is close to 1 lakh crore rupees, and they have not been growing. They are just focusing on converting the corporate loans to the retail loans. In the longer term, retail loans are going to give better returns, right? So a good thing, a positive thing. Third is their net interest margin. The net interest margin is, in a very layman terms, you pay interest to the people who deposit money with you, right? You get interest on the loans that you give out to people. The difference between these two interest rates is the net interest margin. That's how banks make their money. So the net interest margin of IDFC First Bank in December 2018 quarter was 2.9%, and now it is 4.24%. It has been consistently growing. Again, as I already told you, the key reason is retail loans. Since they are focusing a lot on retail loans, and retail loans give higher interest rates, that's why the net interest margin of IDFC First Bank is improving, and it is bound to improve in the coming few quarters as well. Why? Because their fraction of retail loans is increasing. Okay, so the target is 5%. Again, quite achievable in not even in 5 years, but probably in the next 2-3 years. Talk about the NPA numbers, non-performing asset numbers. So gross NPA 2.6%, net NPA 0.94%. Manageable, not a very high number. It's quite manageable. Of course, it's because of the moratorium impact that people can defer their payments of EMIs. Now let's talk about CASA, current and savings account. Why is CASA important for a bank? Whenever you keep money with your bank, it's either in your savings account, or for businesses in their current account, or you keep them in fixed deposits. So the interest that you get in current and savings account is quite less than the interests that you get in your fixed deposits. That's why maintaining a CASA account is very cheap for a bank. More the number of CASA accounts, higher the net interest margin, higher the profitability of the banks become, because they just have to pay little money to maintain those accounts, right? So the CASA percentage of the bank was 8.68% in December 2018, and now it is 31.87 as of March 2020. You can see a huge boost, and this number is consistently growing. There has not been a single quarter where this number has gone down. It has consistently been increasing, and we expect it to increase in the coming few quarters as well. So net interest margin is surely going to increase, a very good thing. And yes, okay, so yes, this was about the CASA accounts. Now there was some concern about the CAR of the bank, the capital adequacy ratio of the bank, which is currently at 13.58%. As of Basel III norms, so the liquidity of the norms, there were several norms defined, several regulations defined worldwide, especially after the financial crisis of 2008, that banks have to keep this much amount of money in pure capital, and there were tiers of capital defined. So that the norms are called Basel I, Basel II, Basel III norms. Basel III is the latest one. And according to Basel III norms, you have to keep about 10.5% as your capital adequacy ratio. Think of it as a money that you keep separate for if something goes wrong. Think of it in that terms, in very layman terms. So the capital adequacy ratio of this bank is 13.38%. For HDFC, it's more than 15-16%. For IDFC, it's just that. Is it a cause of concern? I think it's not, because see, IDFC First Bank has posted its first quarterly profit, and the retained earnings of these profits are going to get back into your tier 1 capital, which will further improve the capital adequacy ratio. So this number is only going to increase in future. There is no cause of concern. There is no concern at all. So don't worry about this ratio. Of course, it's well above the regulatory norms. Okay, so no issues there as well. Next, yes. Okay, we already talked about the COVID impact, right? We already talked about the COVID impact, how it's going to impact. It's going to impact the retail as well as corporate borrowers, both in similar way, and that's why in the coming few quarters, the bank might give subdued earnings. Provisioning will be higher, losses will be higher, but the management quality, the MD and CEO of this bank, V. Vaidyanathan, has an excellent track record. In the long term, we sincerely believe that this bank is going to perform very well. So yes, if you are a long-term investor, you are thinking 5, 10, 20, probably 5-10 years down the line, then this bank is a very good investment as of as per my opinion, as per my research, yes, in the next few quarters, since this is kind of a penny stock, the stock is well below 20 rupees, so a lot of trading activity, a lot of speculation is bound to happen, a lot of volatility will be seen. So it's a high beta stock, and that's why you can see some unexpected down movements as the economic results for the next few months start coming in. As we see recession, we are fearing that a recession might hit India, and in the next few months the stock might get hit hard, especially the banking stocks. This is a part of banking stock, and that's why problems will be seen. But the good thing is that this bank has a very great future ahead. It's going to survive. Of course, it's not the industry leader, but it is going to survive, and it is going to get a decent amount of market share. So yes, please do your research before investing in this stock. This video was only for educational purpose. Post your questions in the comments below so that I'll address all of them. Thanks for watching this far. See you in the next video tomorrow. Bye.